Hi viewers, you are watching Millennium Academy Accounting Hub.
Dear students, in the previous lecture we have discussed financial ratio analysis, in which we have discussed its definition, importance, types and how to use. Today we will discuss the profitability ratio in detail. Let's start. The main object of a business concern is to earn profit. Efficiency in business is measured by profitability. A low profitability may arise due to lack of control over the expenses. The following are important profitability ratios: gross profit ratio, operating profit ratio, net profit ratio, and operating ratio. Dear students, from the following particulars calculate the gross profit ratio. Gross profit ratio is gross profit divided by net sales multiplied by 100. Gross profit equal to net sales minus cost of goods sold. Net sales equal to gross sales minus sales returns. Gross sales is $20,000 minus sales returns $1,000. The amount of net sales is $19,000. Now we calculate cost of goods sold. Opening inventory is $2,000 plus net purchases. Purchase return is deducted from gross purchases. The amount of net purchases is $8,000 less closing inventory is $1,000. Now we find cost of goods sold $9,000, which is deducted from net sales. The amount of gross profit is $10,000. Gross profit ratio is gross profit $10,000 divided by net sales $19,000 multiplied by 100. The gross profit ratio is 52.63%. The second profitability ratio is operating profit ratio. It is calculated as operating profit ratio equal to operating profit is divided by net sales and multiplied by 100. From the following particulars calculate operating profit ratio. First, calculate operating profit. Operating profit equal to gross profit minus administrative and selling expenses. The amount of gross profit is $1,000 minus administrative expenses $300 and selling expenses $500. Operating profit is $200. Now we calculate operating profit ratio. Operating profit $200 is divided by net sales $3,000 multiplied by 100. The operating profit ratio is 6.67%. This ratio helps in determining the ability of the management in running the business. Net profit ratio. It is calculated as net profit ratio expresses the relationship between net profit after tax and sales. This ratio measures the overall profitability of a business. Example: if net profit after tax is $5,000 and net sales is $12,000, calculate net profit ratio. Net profit after tax is $5,000 divided by net sales $12,000 multiplied by 100. The net profit ratio is 41.67%. Higher the net profit ratio, higher is the profitability of the business. Operating ratio is calculated as cost of goods sold plus operating expenses, divided by net sales multiplied by 100. From the following information details, calculate the operating ratio. Operating ratio equal to the cost of goods sold is $6,000 plus operating expenses $500, divided by net sales $8,000, multiplied by 100. The operating ratio is 81.25%.
If you like a video, then please subscribe to our channel and press bell icon for regular updates.